Hello there, this is Rafael, Certified Main Street Tax Pro Advisor, also participant of 2026 Annual Filing Season Program with the IRS. 20 years of experience helping small business owners increase their personal cash flow, save money on taxes, and retire early. Well, the reason I wanted to make this video today is because 2026 tax season is here. I've been having meetings with clients, and it is a common theme, the fact that everybody wants to save money on taxes. Everybody wants to save money on taxes in a way in which it's going to keep them out of jail. And my advice is always real estate. Real estate is probably one of the places in which you can find great deductions that you can utilize for the year if it's done right. It's a place where you can create wealth for your family and you can transfer that wealth to your family, potentially tax-free, if you play the game right. So with that being said, right now there's a lot of noise in social media about short-term rentals, in which people are telling you, get an Airbnb, don't worry about it. You can take the whole amount of the house as a tax write-off and everything is going to be fine. This video is a meeting that I just had with a client, in which we were kind of making sure that the client had all the details regarding to setting up a short-term rental. So basically a short-term rental is a property that you buy. Most of the time you purchase the property and you rent it out on average less than 7 days to the same person or same party. And you rent it out throughout the whole year. Well, most people think that, I can just rent out the property, pay somebody to go and clean the property, pay somebody to go and take care of the electrical, the plumbing, and all that kind of good stuff. And everything is going to be fine. I really don't have to do anything, just to click a couple times on whatever service you're using. The most common one is Airbnb, but I just got to go to Airbnb and approve the tenant, and that's it. In order for you to be able to take advantage of those deductions, you need something what is called material participation on the property. Material participation means that you have to put more hours working into that property than anybody else out there. And you gotta put at least 100 hours into that property. So if your goal is to just buy the property and just hire out all the work, and you just are gonna click here every once in a while when you need to approve a tenant, that's not gonna give you material participation. First of all, it will be really hard for you to gain 100 hours throughout the year in order to qualify for material participation. And second, you have to put more work into the property than anybody else out there. You gotta put more work into the property than the person cleaning the property, the person working on the plumbing, and so on. If you're gonna go with the short-term rental, be careful what is out there in social media. You do want to make sure that you get the right advice, that you really understand that material participation is real, that you have to put at least 100 hours into the property, and you have to work more than anybody else involved into this project in order to be able to take the deduction. Now, something else to think about short-term rental is that the strategy here is that you're going to be doing it for a long period of time. Short-term rental is not something that you do year one and then year two, like, I don't want to do that. And then a couple of years from now, you're playing games. You say, oh no, I'm going to be short-term rental again. And you're flipping back and forth. The strategy here is, if you're going to do a short-term rental, you want to do it at least for a few years short-term, in which you're putting material participation in it. You're renting the place less than 7 days to the one party on average for the year. And you want to go a few years doing that. And then after a few years, if you're tired of doing that, yeah, you can flip to a long-term rental, in which you can just rent it out for a contract of a year, 2, 3, 5 years to somebody else, in which the whole game changes. The losses that you're going to be generating in the property are going to change, and your depreciation also is going to change. And the way how you capture the depreciation is going to change. But with the short-term rental, one of the important things is on year number one, you get to take bonus depreciation. And when you buy, in a very simplistic way, when you buy a property, let's say you buy a $400,000 property, you got to divide this property in 3 different areas. Land is one of them. Land is not depreciable. And then whatever, let's say, $400K, and you are in a very expensive area where land is worth $100K. Now you have $300,000 of what we call personal property and real property. Real property is everything that is attached to the house, right? The roof, the walls, and everything else. But personal property is something that is not attached to it. It's kind of like an operating equipment, like the stove, the air conditioning, the furnace, and so on. In order for you to be able to segregate all those different elements in the property, you need to do something what is called a cost segregation analysis. A cost segregation analysis is where you actually pay an engineering firm to go and do a study on the property. It can go from, a really cheap one, it could go from $500, and a very expensive one, you can pay $3,000. It all depends how involved you want to get. But basically, the cost segregation study is going to segregate the different kinds of property, different kinds of values that you have inside the property, the land, real property, and personal property. And within that personal property inside the house, and I know this is pretty confusing, you're going to have certain things that are, depreciable within 5 or 15 years. It has a lifespan of, 5 to 15 years. And those are the things that you're going to be able to take bonus depreciation on. Most people don't understand this concept, but on a short-term rental, the real benefit is on year one when you put it in place. Be careful also if you are converting your home into a short-term rental, because you might want to move out of the house and then the next year do the short-term rental. Because if you convert your home in the same year in which you were living in the house, you're going to be subject to some home limitations, some home income limitations that you're not going to like. And so if your plan is to take your home and convert it into short-term rental, you might want to move out and place it on the short-term rental strategy year number one, the following year, the year after you are completely out of the house. More questions about that, let me know. But I just kind of wanted to make this video so people understand that the real benefit is on year one when you get to take the bonus depreciation, which is going to create like a pretty big depreciation for you that you're going to be able to take against your earned income. Earned income will be like your W-2, 1099s, and all that kind of stuff. So you want to make sure that, if that's your strategy and you want to take advantage of that first year, yeah, do that. But know that the second, third, fourth year in which you're renting out the place, yeah, you're going to get some losses, but it's not going to be as juicy as some people in the internet are telling you. So if you want more information about the short-term loophole to help you out avoid a whole bunch of taxes on year one in which you put it in place, send me a DM. I'll be more than glad to talk to you. And again, we're here to help. Thank you again for watching.